There's a lot of talk today about taxing the rich and having them pay their fair share. Stay tuned today to find out if you're rich or poor, if your income is common or uncommon, and how this new knowledge may be used in your financial planning.
Welcome to this episode of Plan Your Wealth with Purpose, Principles for Investing and Wealth Creation, with Wealth Creation's education and tax coach, Jim Fisher. James Fisher is a registered advisor offering investment advice through Signature Investments, Inc., an SEC-registered investment advisor, Dayton, Ohio. James Fisher CPA and Wealth Creations is unaffiliated with Signature Investments, Inc.
To make decisions, we need a baseline. Every business has numerous accountants, marketers, and statisticians scouring tons of information to help formulate business plans. So when we go about our own personal financial planning, shouldn't we be doing the same? Having an accurate baseline versus a guess could be the difference between failure or success. To illustrate, I'd like to play with you what I call the income game. Would you say your income is common or uncommon? On my right, you'll see a slide, and I want you to mentally guess what a family household income would be to fall in the top 25%, 10%, 5%, and then 1% of all American households. Take a second to do this. Got your answers? Now on the next slide, you'll see the actual data, along with the percent of taxes paid. Soak this in a little bit. I am sure there are many of you that fall within the top 25%, if not the top 10%. If you're like most people, your guesses range from about $100,000 to $1 million. So maybe you were off a little, but just like a business, having the wrong information can drastically affect the choices of action and the outcome. So now that you know whether your household income is common or uncommon, let's examine the tax rate history. The income tax started in 1913 with a top rate of 7%. As you can see, the rates quickly rose and went as high as 94%, and we are currently well below the historical average of 58%. As a tax CPA, I can tell you, with all the exemptions, deductions, college credits, energy credits, etc., the average family is paying a relatively low average rate of 3 to 13% of their income. Unfortunately, I don't see the same for retirees. You see, retirees usually don't have all the additional deductions, and to make matters worse, most pay tax on up to 85% of their Social Security income because they meet other income thresholds. In other words, they are considered well off enough to pay more taxes. They get double whammied and end up paying a larger percent of taxes in retirement than in their working years. My whole point of this boils down to a couple of points. Armed with the information of where you stand in relation to others, and the tax history, and the current state of affairs with almost $18 trillion in federal debt, do you think the tax rates might be going up in the future? And will you be a target? Most families are headed right into the tax torpedo at retirement. That's because no one has told them differently. Times have changed over the last 20 years. If you want to increase your financial security and increase your retirement cash flow because you fall in the top 25%, don't you think in a holistic approach that takes in all the years of your life, the accumulation phase and the disbursement phase would be important? With this baseline information, how will you use it to chart your financial planning? If you'd like to start your journey, visit my website to get started or give me a call.
Thank you for watching this episode of Plan Your Wealth with Purpose with Jim Fisher. For more information, visit wealth-creations.com. Also browse the other shows found right here at Toledo Biz TV Show.